Hey everyone, welcome back to Freedom Jump. Today, we're diving into a strategy that could help you build wealth over time, buying the dip in the stock market. You've probably heard this phrase thrown around, but what does it actually mean? And more importantly, why is it a good idea? Stick around, because by the end of this video, you'll understand how this strategy can help you get out of debt and on your way to financial freedom. If you're ready to level up your investing game, hit that like button, subscribe, and let's get started. What does buying the dip even mean? It's pretty simple. When the stock market, or a specific stock, drops in price, that's called a dip. Buying the dip means purchasing those stocks at a lower price, with the expectation that they'll go back up in value over time. Think of it like snagging a deal during a sale, but instead of clothes or gadgets, you're buying a piece of a company. Reason number one, you're essentially getting stocks on sale. When the market dips, it's often due to short-term fear or uncertainty, like a bad earnings report, economic news, or even global events. But if you're investing in solid companies with strong fundamentals, those dips are usually temporary. Buying low means you're setting yourself up for bigger gains when the price recovers. Reason number two, buying the dip forces you to think long-term. The stock market can be an emotional roller coaster, and it's easy to panic when prices drop. But history shows that the market tends to go up over time. For example, the S&P 500 has returned an average of about 10% annually over the past century, despite countless dips along the way. By buying the dip, you're training yourself to stay calm and focus on the bigger picture. There are opportunities. Investors like Warren Buffett have made billions by staying patient and buying when others are selling. Reason number three, buying the dip can accelerate your journey to financial freedom. Let's say you're working on paying off debt. If you're investing small amounts consistently, buying the dip can help your portfolio grow faster. Those gains can then be used to pay off debt or build wealth, getting you out of debt and into a better financial position. Now that you know why buying the dip is a good idea, let's talk about how to do it. Here are 3 practical tips to get started. Make sure you're investing in quality companies. A dip isn't a good deal if the company is going bankrupt. Look for businesses with strong fundamentals, like consistent revenue growth, low debt, and a competitive edge in their industry. Second, keep some cash on hand. You can't buy the dip if you don't have money to invest. I recommend setting aside a small portion of your portfolio as dry powder, money you can use to jump on opportunities when the market drops. Third, consider dollar-cost averaging. Instead of trying to time the market perfectly, invest a fixed amount regularly, like $100 a month. When prices dip, your money buys more shares, and when prices are high, you buy fewer. Over time, this strategy can lower your average cost per share. Now, I'd be doing you a disservice if I didn't mention the risks. Buying the dip isn't foolproof. Sometimes a stock dips because the company is in real trouble, and it might not recover. That's why research is so important. Also, the market can stay down for longer than you expect, sometimes months or even years. So, only invest money you can afford to leave in the market for the long haul. But if you're patient and strategic, the rewards can be worth it. The market tends to trend up over time. So, there you have it. Why buying the dip in the market is a good idea. It's a strategy that lets you buy low, think long-term, and potentially get out of debt faster. If you found this video helpful, give it a thumbs up, and don't forget to subscribe for more tips on investing, personal finance, and building wealth. What's your favorite investing strategy? Let me know in the comments below. I'd love to hear from you.